Welcome to Section 4 of the ASC 480 series. We have covered classification, liability categories, and the fixed-for-fixed test. Now we turn to what comes after classification: measurement. How do you initially record these instruments, and how do they change on the balance sheet over time? We will also cover mezzanine equity, the third balance sheet zone that sits between liabilities and permanent equity, and how convertible instruments interact with a SC 470. After this section, you will be able to apply the correct initial measurement basis to each type of a SC 480 instrument. You will know which instruments require ongoing fair value remeasurement and which are accreted to their settlement amount. You will understand mezzanine equity, what it is, when it applies, and who it applies to. You will navigate the three-zone classification spectrum from liability to mezzanine to permanent equity. And you will analyze convertible instruments with confidence, knowing where a SC 480 ends and a SC 470 begins. Initial measurement under a SC 480 depends on which category of instrument you are dealing with. Mandatorily redeemable instruments are initially measured at fair value at issuance. In most cases, this equals the cash received from the holder. Variable share obligations are measured at the fixed dollar amount the entity owes straightforward because the obligation is defined in monetary terms. Written put options are measured at fair value at the date they are written, which typically equals the premium received from the counterparty. Forward repurchase contracts are measured at fair value at inception, which may be zero if the forward price equals the current market price at the money. These are different starting points for different instruments. Do not apply one rule to all of them. Here is where the ongoing accounting burden of a SC 480 instruments becomes clear. Written put options and forward repurchase contracts must be remeasured to fair value at every single reporting date, with every change, gain, or loss flowing through the income statement. There is no deferral, no other comprehensive income, no smoothing. It goes straight to P&L for mandatorily redeemable instruments. If the settlement amount is variable, fair value measurement applies. If the settlement amount is fixed, as in a fixed redemption price, the carrying amount is accreted toward that settlement price using the effective interest method, which generates periodic interest expense. Variable share obligations with fixed monetary amounts are carried at that fixed amount. The principle is, where the obligation can change, fair value captures that change through earnings. Most people think of the balance sheet as having two zones, liabilities and equity. A SC 480 introduces a third. Zone 1 is the liabilities section, for instruments that are mandatorily redeemable or that otherwise satisfy one of the three ASC 480 liability categories. Zone 3 is permanent equity, instruments with no redemption requirement and no features outside the entity's control. But between these two zones lives Zone 2, mezzanine equity. This is the home for instruments that are not quite liabilities, because redemption is contingent on an uncertain event, but also cannot be permanent equity because redemption could be forced on the entity. Understanding this three-zone spectrum is essential for correctly positioning every instrument on the balance sheet. Mezzanine equity is a SEC-specific concept. It is required for public registrants but not mandated for private companies. Here is when it applies. The instrument is not a liability under a SC 480 because the redemption trigger is contingent on an uncertain event. An IPO that may or may not happen. A change of control that may never occur. The trigger is not certain, so the instrument is not mandatorily redeemable. But the potential redemption is also outside the entity's control. If that uncertain event occurs, the entity must pay. That makes permanent equity classification inappropriate. The solution is mezzanine equity, a separate balance sheet section between the liabilities section and stockholders' equity, typically labeled redeemable preferred stock or temporary equity. In practice, mezzanine equity appears as a separate labeled section on the face of the balance sheet, between the liabilities section and the permanent stockholders' equity section. It is typically described as redeemable preferred stock or temporary equity. The key practical point: this is primarily a public company requirement driven by SEC guidance. Private companies generally do not present mezzanine equity. But here is an important nuance for companies preparing for a public offering. Once a company anticipates going public, it typically needs to start retroactively presenting mezzanine equity in its historical financial statements. Teams working with pre-IPO clients need to assess this early, not at the last minute before the offering. Convertible instruments sit at the intersection of two standards, and the first question is always which standard governs. If the conversion feature requires the entity to deliver a variable number of shares to satisfy a fixed dollar amount, a SC 480 applies, and the instrument is a liability. If conversion delivers a fixed number of shares, a SC 480's category tests are generally not triggered for the conversion feature itself, and the analysis moves to a SC 470-20 for the debt component. One critical point on current US GAAP: following the adoption of a SU 2020-06, most convertible instruments under US GAAP are now treated as a single liability unit. There is no mandatory bifurcation into a debt component and an equity component. This is a significant difference from IFRS, which still requires mandatory split accounting. Let us map the full classification spectrum one more time. An instrument that is mandatorily redeemable at a certain event creates a variable share obligation, or is a written put or forward repurchase contract. It is a liability, and it sits in the liabilities section. An instrument redeemable upon an uncertain event outside the entity's control, not certain enough for a SC 480 liability, but not stable enough for permanent equity, sits in mezzanine. And an instrument that satisfies fixed for fixed with no redemption features outside the entity's control sits in permanent stockholders' equity. Each zone has its own measurement rules, its own P&L implications, and its own disclosure requirements. Measurement under a SC 480 is not one size fits all. The starting point and the ongoing measurement basis depend on the category of instrument and whether the settlement amount is fixed or variable. Mezzanine equity is its own zone on the balance sheet, required for public companies whenever redemption is possible outside the entity's control. For convertibles, the fixed shares or fixed dollars question drives the whole analysis. And the post-ASU 2020-06 single-unit treatment for most US GAAP convertibles means that US GAAP and IFRS now produce materially different results for the same instrument. In the next section, we build the journal entries for each of these scenarios. Thank you for completing this section on measurement, mezzanine equity, and convertibles. Thank you for watching. Subscribe for more training from PNJ Group.